People move to Florida for a reason: the sunshine, the waterfront, the retirement dream, the promise of no state income tax, and a slower, cheaper life. They came from Ohio and Michigan and New York, and they signed on the dotted line. Then one day an envelope arrived. Not a rate increase, a non-renewal. The private insurance market did not raise the price. It simply stopped showing up. And it did not happen everywhere. It happened in specific towns. Here are 10 of them. Number 1 will not surprise you. It will just finally make sense. Number 10, Okeechobee. Most people picture Florida's insurance crisis on the coast, but Okeechobee is inland cattle country, affordable, quiet, the kind of town where a working family could actually own something. Then the non-renewal letters arrived. Here's the part that matters. Okeechobee is not a coastal hurricane target. The storm risk does not explain the non-renewal rate. A December 2024 Senate Budget Committee report identified the Lake Okeechobee cluster as having among the highest non-renewal rates in the entire state, not because of storm exposure, but because poorer markets with older housing stock produce thin margins for insurers, low premium volume, limited litigation from residents who can't afford to fight denials. The return on investment calculation failed. Insurers moved to better markets. Residents without mortgages are increasingly going uninsured entirely. The storm didn't come for Okeechobee. The insurers did. Number 9, Moore Haven, Glades County. Glades County had the single highest insurance non-renewal rate of any county in Florida in the most recent available data. Not Miami-Dade, not Monroe. Glades, the state's poorest county, with a median household income under $39,000. The mechanism is the same as Okeechobee, but more extreme. Modest homes, rural lots, residents least able to challenge a claim denial, and a policy pool too small and too low margin for private carriers to justify staying. When Citizens becomes the only option and raises rates, some homeowners simply let coverage lapse. A home without insurance cannot be sold to a buyer with a mortgage. The transaction market quietly stops working. Property values stagnate without a headline, without a crash, without anyone noticing from outside. The private market left quietly. The houses are still there. The buyers can't get financing. Number 8, Mexico Beach. Before Hurricane Michael, Mexico Beach was the secret panhandle. Small, affordable, genuinely old Florida. Then Michael made landfall in October 2018 as a Category 5, the first to hit the continental United States since Andrew in 1992, and erased most of it. The rebuild took years, but the deeper damage was to the insurer model for the entire panhandle. Gulf and Franklin counties showed elevated non-renewal rates as private carriers recalculated their exposure. Some longtime owners sold at discounts to developers who could absorb the cost. The old character of the town, with modest cottages, working families, and an affordable beach community, is unlikely to return at the new insurance pricing. The storm did not end Mexico Beach. The insurance math after the storm did. Number 7, Cedar Key. Cedar Key was the hidden gem, artsy, remote, authentically Gulf Coast, the kind of slow Florida that people drove hours to find. Then 3 hurricanes arrived in 13 months. Idalia in 2023, Debbie in 2024. Helene's effects reached Levy County in late 2024. The same small, low-lying cluster of islands was hit 3 times before residents could fully recover from the first. Private carriers had modeled Cedar Key as low priority. 3 storms in 13 months erased that model. Levy County appeared in elevated non-renewal data. Citizens became the dominant option at rising rates. The lifestyle math that made Cedar Key attractive, with a modest home, affordable insurance, and a quiet Gulf life, stopped adding up. The charm was always the isolation. The isolation became the trap. The insurers just stopped coming. Number 6, Port St. Joe and Apalachicola, Franklin County. Franklin County is one of the least developed coastlines left on the Gulf. Apalachicola oysters, slow river life, affordable waterfront. People chose it specifically because it wasn't Destin. It wasn't 30A. It was the forgotten coast, and that identity attracted buyers priced out of everywhere else on the panhandle. The private insurance math here is structural. A small population means thin premium volume. Full coastal exposure means high catastrophe risk per policy. The ratio doesn't work. After Hurricane Michael repriced the entire Panhandle's risk profile, Franklin County followed into elevated non-renewal territory. Citizens became the primary option. And when Citizens raises rates toward market levels, homes that seemed like affordable hidden gems start looking different on the monthly payment spreadsheet. People chose the forgotten coast because the rest of Florida forgot it. The insurers didn't forget. They just stopped coming. At this point, you might be thinking, these are small towns, rural counties, obscure panhandle communities, the kind of places national headlines skip. But the same insurance math that abandoned Glades County did not stop at the county lines of small, rural Florida. It followed the premium dollars into the places that made the cover of lifestyle magazines. Into the towns people across the country could picture when they closed their eyes and thought about retiring somewhere warm and beautiful. The next four are those places. Number 5, LaBelle, Hendry County. Hendry County sits in the Lake Okeechobee Inland Arc, and it rounds out the most important structural twist on this entire list. Interior South Florida communities, cheap land, working-class home ownership, the kind of Florida that never made a travel magazine, faced some of the worst non-renewal rates in the state despite sitting nowhere near the storm corridors that dominate insurance headlines. Miami-Dade, Monroe, Broward, and Lee all carry higher expected storm losses per building value than Hendry County. Yet Hendry got non-renewed at elevated rates. The reason is purely financial. Poorer markets create unprofitable policy pools. Older housing stock costs more to process per claim relative to premiums collected. Private carriers made a quiet calculation and left. Homeowners who paid off their mortgages decades ago now find they cannot sell to financed buyers because no affordable coverage exists to satisfy a lender. The storm did not pick these towns. The spreadsheet did. Number 4, Cape Coral. For decades, Cape Coral was the answer to one question. How do you get waterfront Florida without waterfront prices? Over 400 miles of canals, a boat dock in the backyard, direct Gulf access, and a median price point that made it one of the best values for a Florida waterfront lifestyle anywhere in the country. Then Ian arrived, and then the full insurance picture arrived with it. Here is what most buyers relocating to Cape Coral today still don't fully price in before they start touring homes. Nearly every canal property carries a mandatory flood insurance requirement entirely separate from the homeowner's policy. After Ian, the federal flood program updated its pricing under Risk Rating 2.0, recalculating premiums based on specific property-level risk. Older canal homes built before current elevation codes took the hardest hit. Add wind coverage, add the base homeowner's policy. The combined insurance bill on an older canal property can run well into 5 figures annually. Homes were sitting more than 70 days on market in early 2025. Nearly 45% of listings showed price reductions at one point. The city became a buyer's market with 6 to 9 months of inventory. A buyer from Ohio sees a canal home in the mid-300s and thinks they found the deal. Then the insurance broker runs the numbers. The dream is still there. The listing photo still sells it. The insurance bill is what the listing photo never showed. Number 3, Fort Myers Beach. 3 years after Ian, construction equipment still lines Estero Island. New homes are going up beside vacant lots. The Fort Myers Beach Chamber of Commerce director, whose own hotel was washed away, told reporters, "We are nowhere near where we thought we would be." Fort Myers Beach was old Florida barrier island. Wood frame cottages, family hotels, modest and unpretentious and affordable by coastal standards. Ian damaged or destroyed a massive portion of the housing stock. Insurance premiums on Estero Island jumped from roughly $9,000 to nearly $14,000 annually between 2019 and 2024, according to First Street Foundation data. By late 2025, the median sale price was down nearly 20% year over year, with homes sitting an average of 175 days on market. The deeper story is economic displacement. FEMA required rebuilt structures to meet current elevation standards, which pushed construction costs sharply higher. The new Fort Myers Beach is more resilient. It is also more expensive, and the working-class residents, small hotel operators, and modest cottage owners who gave the town its character are largely priced out of the version being built to replace it. The storm didn't end Fort Myers Beach. The cost of rebuilding it did, for everyone who used to call it home. Number 2. Sanibel Island. Before Ian, Sanibel was on every best places to retire list and deserved to be. A 12-mile barrier island with world-class shelling beaches, a federal wildlife refuge covering a third of its land, strict development limits that kept the character intact for decades. Expensive, but genuinely special. The real Gulf Coast, preserved. The island had not seen a major hurricane in decades. Insurers modeled it accordingly. Then Ian pushed 12 feet of storm surge across Sanibel, collapsed part of the causeway, flooded thousands of homes, and triggered $620 million in federal flood insurance claims, roughly 100 times more than the program had paid out to Sanibel homeowners over the previous 40 years combined. 40 years of favorable loss modeling erased in one night. Private insurers recategorized the island immediately. Post-Ian premiums ran toward $7,000 annually for barrier island exposure before flood coverage was added. Then Helene and Milton arrived in 2024. By mid-2025, housing inventory had surged well beyond the pace of sales. As owners who had held on through the first recovery year began listing, many of them older retirees accelerating plans to move closer to family or into care communities. The island's greatest strength, its preserved, low-density, unhurried character, turned out to be exactly the configuration most vulnerable to what Ian delivered. The ground-level homes, the older construction, the decades of limited rebuilding that kept Sanibel feeling like old Florida. All of it worked perfectly until the water came. Sanibel spent decades protecting itself from overdevelopment. One storm proved it was not protecting itself from the right thing. Number 1. The Florida Keys, Monroe County. The Keys were where you went when regular Florida wasn't enough. Key West, Marathon, Islamorada, Key Largo, water on both sides, sunsets that stopped people in their tracks, a pace of life so distinct from the mainland that people spent years rearranging their lives to move there. Monroe County now has the highest average homeowners insurance premiums in Florida, roughly $7,100 annually in 2025 on average. But that average includes newer elevated construction with better mitigation credits. For older homes on open water, the combined picture of wind, flood, and homeowners insurance can run from $8,000 to well beyond that annually, depending on the structure and zone. Citizens Property Insurance covers roughly 20,000 Monroe County properties. The firm organization representing Keys homeowners went to the state legislature and submitted language acknowledging that Monroe County has no reasonable degree of private market competition, not limited competition, no reasonable degree of it. The reason every insurer reaches the same conclusion is geography. One road in and one road out. Storm surge risk from two directions simultaneously, Atlantic and Gulf, with no natural barrier. Post-storm rebuild costs are elevated by island logistics. Evacuation constraints are factored into every risk model. Private carriers looked at that matrix and declined. Citizens absorbed what the market refused. A family buying a $600,000 home in Key Largo faces $800 to $1,300 a month in combined insurance costs before the mortgage, before taxes, before homeowners association fees. The people still buying in volume are cash buyers and investors who can self-insure. The retiree who saved for 20 years to sit on a dock in Marathon is running the numbers and finding the dream and the bill are living in two different realities. You cannot get more Florida than the Keys. You also cannot get more exposed. The private market made its decision and left quietly. What remains is the dream, the water, and a bill that most buyers were never shown before they signed. None of these towns stopped being beautiful. The sunsets in the Keys are the same. The canals in Cape Coral still catch the light. Cedar Key still has the same quiet streets that made people drive hours to visit. The dream didn't become a lie. It became expensive in ways the listing price never communicated, ways that showed up later, in the renewal letter, in the insurance quote, in the first full year of ownership when the real bill finally arrived. Which town on this list surprised you most? Have you watched a neighbor quietly sell and leave without explaining why? Drop it in the comments. The most important real estate stories in Florida are not in the national headlines. They are in the mailbox. Subscribe if you want the ones that actually matter.